and welcome to our post-budget webinar. As with all seminars, I need to start with a formal announcement. Hopefully you're aware of your own fire exits, but I do need to let you know that this webinar is being recorded. It was over 160 years ago that Charles Darwin's Origin of Species was published, but the survival of the most adaptable has never seemed so prescient. We have seen established stalwarts of the high street failing due to inadequately adapting to internet trading, and COVID has acted as their tercio de muerte. Within the world of tax planning, understanding changing rules and being nimble enough to adapt to them has never been so important. After a series of supportive announcements last year, there is some expectation that yesterday's modest budget statement was the first in a succession of fiscal belt-tightening measures to be announced this year. Procuring the best advice to react to these changes is imperative for businesses and individuals alike to ensure they remain compliant and tax efficient. With this in mind, I am delighted to introduce you to this morning's panel of Burgess Hodgson experts. First, we have Ken Jones. Ken trained at Burgess Hodgson, consistently winning prizes throughout his professional exams, both in accountancy and taxation. Accordingly, there was a sense of inevitability when Ken became a partner at the firm. Ken's technical expertise is phenomenal, as I have had the pleasure to witness firsthand. Included within his experience, he has taken companies through significant corporate events, such as flotation, stock exchange reporting, and public to private takeover. More typically, he helps businesses and families with long-term strategy and tax planning. Next up, we have Martin West.
Morning.
Martin has been a partner at Burgess Hodgson for 10 years. Over the last few years, or at least before lockdown, he probably picked up the most business miles in the firm. As well as having many clients in London, he regularly visits clients throughout the UK. Martin spends considerable time developing clients' reporting processes in the tech startup environment. He has also become the firm's specialist in home office, providing monthly wealth reports for ultra-high net worth families. And finally, we have Fiona Wilkes. Fiona is a multidisciplinary tax expert. The style of entrepreneurial clients and work that the firm attracts means that she has necessarily become an expert in EIS and SEIS investments, as well as incentive schemes for management and employees. She balances this with the management of our personal tax department, which has just submitted well over 4,000 returns. And she retains a portfolio of the firm's high net worth clients. This morning, we're going to be using a question and answer format. We have been inundated with questions overnight, but if there is a question you would like to ask, please do use the Q&A tab that should be in an icon at the bottom of your screen. But I will start this morning with a question that has come overnight, and this is going to be one for you, I think, Fiona, please. We have an individual who says their business has struggled throughout the lockdown. They've used the furlough scheme for some of their staff since April 2020. They've stopped paying the associated PAYE costs to HMRC. And their question is, will this affect their furlough claim? And what should they be doing next?
Right, quite possibly it could affect their furlough claim. It is a requirement of the legislation that a company is up to date with their pay-as-you-earn before they make a furlough claim. So HMRC could well block that until such time as the pay-as-you-earn is paid in full. We can do catch-up payment or also maybe agree a payment plan with HMRC to bring that up to date.
Yeah, just to add to that, Fiona, I think we've got clients that are still putting their furlough claims through naturally and haven't been able to meet the HMRC deadline for PAYE. Some of those are still going through. So what Fiona's talking about is the rules, you know, you're meant to keep up to date as part of that. Within the back of this budget, HMRC have confirmed they're putting more money into checking that the furlough claims are correct. So even if you don't get immediately caught out, it's likely to be a question that you've got to deal with at some point. So it's worth planning for.
Yeah, I'd agree with all of that. I think the key thing is to talk to HMRC and trying to come to some sort of time to pay sort of arrangement with them at an early stage rather than waiting for them to get upset and start recovery proceedings.
And they've generally been good, haven't they, Ken, with the time to pay? Not always in the past, but they're certainly aware of the pandemic for obvious reasons. And you can certainly get at least 12 months in a lot of cases if you can give the right information. So we are finding them being pretty open to a time to pay arrangement.
Absolutely, Martin. I mean, we've seen that in other areas where there's an automatic time to pay arrangements for smaller debts anyway, which we maybe talk about later. But yeah, HMRC are being reasonable on time to pay.
Super, thank you, T. Martin, there was a talk of a new super deduction. What is that, please?
So this is the government are trying to encourage us during these difficult times to still invest in the future for our businesses and by default for the country's future benefit as well. So they've brought in some extra provisions for anyone investing in plant and machinery over the next couple of years to get what they class as super deduction. Fiona will be able to give more detail in terms of the actual specifics on the tax, but it's to encourage people to still look to invest in those capital assets that quite often gets put on the back burner when things are tight or when there's doubt. And I think the message was very much, we're here to support you and give you the opportunities to still invest in both your company's future, but naturally as a result, the country's future.
Sure, thank you.
That's right. The investment of say £100,000 would get you 130% to 130,000 as a deduction. So that equates to 25p on every pound. That is more than the current annual investment allowance will receive as a tax deduction. It's on new plant and machinery, not cars, unfortunately, not leased assets. And there's also an additional one that would be for integral features. So things that are in the fabric of a building, air conditioning, electrical wiring, etc. And that's at 50% as a first year allowance, which you would normally get 6% on those pools. So anything, especially when people have used up their annual investment allowance, and we may see that the extension of that is only going to be up to the end of December 2021 as £1 million, and then it's intended to come down to 200,000. So for companies that are utilising their whole 200,000, this super deduction gets even better.
Super, thanks, Fiona. We've already got our first question. There's a bit of a follow-up there, and that really is, what does this mean for planning? Martin, again, so if someone is thinking about how this affects what they do over the next couple of years, what should they be doing? Does this mean they delay their investment until this rate comes in, or what should they be doing?
Well, there's a few things on this. The budget, I mean, I know many have said there wasn't a huge amount going on in the budget, but most of the things that come out that affect the budget are related to corporation tax for a company, particularly with the super deduction we've already discussed. The corporation tax rate has been kept at 19% for this tax year coming up, but has been flagged up as going up to 25% in some cases. Again, there's bands which I'm sure we'll touch on later. So there's those things to plan for. But because of the 130%, effectively the tax rate I think will come out at very similar rates, because the 130% has allowed for the fact that the step up of the corporation tax is likely to happen. Yeah. And that's then coupled with obviously other planning things. So the timing is important, it's worth looking at, but there's lots of other things within that budget that make corporation tax worth looking at, because they've now opened up that you can take losses back further, for example. So if you've been particularly heavily hit, there is the opportunity to perhaps still invest and get the extra deductions and maybe have carry those back further to get a cash benefit now. So there's lots of things to consider, particularly for a company, and it's certainly worth sort of reaching out and planning where you think your year end is going to finish. I guess the point is you can't let the tax tail wag the commercial dog, and each person's got to try and actually look at their own circumstances before they just take a blanket approach. Brilliant, thanks, Martin.
Absolutely, Matt. Just one point to make clear is that the super deduction of the 130% only applies to companies.
Right, super.
The increase in the annual investment allowance applies to companies, partnerships, and sole traders. But the 130% super deduction is only companies. And just an interesting point on that is, traditionally, people have been trying to put expenditure down as revenue to charge it against the profit and loss account, because traditionally you got tax relief for revenue expenditure straight away and capital expenditure over a period. This is a rather strange situation where you get actually more relief for capital expenditure immediately than you do for revenue expenditure. So it's rather sort of turns the normal arguments on its head. And it'll be very interesting to see if HMRC try and argue the opposite way to which they normally argue when they're disputing these cases. And if they do, then we might use it in evidence against HMRC at a later stage.
Yeah.
By going back to arguing different cases. But
Who says-
it does show how things change.
Yeah, who says what we do isn't an art? Ken, something else for you. There wasn't really the expected changes to capital gains tax. Why do you think this is?
Well, it's a strange one, Matt, because there had been a move towards, or a recommendation that the rates of capital gains tax should be a little more closely aligned to income tax. Traditionally, they've been a long way apart. I mean, if we go back to when capital gains tax first came in 1965, a time which I don't remember particularly well, but I do remember. In 1965, it came in at a rate of 30%. And yet, that continued through to when we had 75%, plus income tax rates up to 98 even. So there's always been a difference. So it was only really in the sort of 1980s, the rates were aligned for a relatively short period, and then they were moved apart. So traditionally, income has been taxed higher than capital gains. Why didn't he address that this time around? Well, one of the things about the capital gains tax and the reliefs is that it encourages enterprise. Having a relatively low rate of 10% if you're within the entrepreneur's relief, or 20% if you're above that, is obviously a much better rate than 45% income tax. And really the Chancellor at the moment, the whole sort of theme of his budget is to try and encourage enterprise, because if you look at the sort of tables of tax take, of which there's quite a useful one at the back of the sort of Treasury Red Book, you realise that actually it's a very small amount of tax is contributed by capital gains tax in relation to the huge amount of tax which are contributed by PAYE, national insurance on people earning, VAT, people spending, and then latterly with corporation tax. So really, in terms of enterprise, it's worth having a relatively low rate of tax to encourage enterprise. If on the other hand, those entrepreneurs are going to generate PAYE, national insurance, people, their customers are going to spend money and pay VAT, and they're going to pay corporation tax. Now,
and hopefully now everyone can see why we love working in a partnership with people like Ken, because every day is a school day, even for us. It's fantastic.
Well, it may not last, Matt. I mean, there may be a move to move them a bit closer, but at the moment, I mean, one of the things that the Chancellor said, this is, a budget to try and regenerate the economy, and enterprises at the sort of heart of it.
Yeah, the wording, Ken, I think he's frozen the capital gains tax annual exemption, so that there's certainty that remains, albeit it won't go up with inflation. But he was a little bit quiet in terms of actually confirming capital gains tax will stay as is over the next 2 years, whereas a lot of the other rates were frozen, weren't there? So there's still, as you say, there's still scope for him to revise that and look at it. But it felt very much like a budget for now, considering we're still, ultimately in lockdown. So there's definitely the option there for that rate to go. So it's worth keeping an eye out on that.
Yeah, guys, I will have to move on. We've got a line of questions coming through now, so I'm going to have to sort of move on fairly swiftly. Fiona, IR35, not mentioned in the budget. What's happening, please?
No, IR35 was already delayed from the 5th of April 2020 due to coronavirus and is coming in as at the 6th of April 2021. If you look at the small print of the budget, there was a little bit of tidying up of the legislation. Now HMRC can target anybody in a supply chain or working chain if there is some fraudulent, fraudulent activity, and that will hopefully protect the end client who have relied on fraudulent information without knowing, whereas before the onus may have been on the end client. But otherwise, it's coming in as stated in the earlier budget as of the 6th of April 2021.
Super. Thank you very much. Martin,
Yes.
I think this actually is probably slightly outside the budget, but someone's asked about the recovery loans with 80% government-backed security, and they're asking, should they be pursuing these for the bank, and can they use them for growth?
Yeah, absolutely. So if we just wind back a second, we've got CBILS bounce back loans are still available up to the 31st of March. So if anyone hasn't looked at those, they're still very much on the table right now. These loans are effectively coming in early April. So there's only about a week between the bounce back loan finishing and these recovery loans coming in. They've given some indication of the sort of requirements, and the initial information is very, very similar to what was used for a bounce back loan. So you look at the balance sheet, you have to prove that your business is either valid now or was certainly valid before the pandemic hit to prove that you're something worth backing. So that normally involves forecasts, certainly making sure your accounts are up to date and be able to show that pattern. But absolutely, certainly on my client base, I'll be encouraging anyone that has a look at their business and feels like there's an opportunity there, because particularly with the super deduction we've talking about for capital allowances and other things as well, there's lots of other ways to shape that funding using the government backing as well. So those recovery loans could be quite helpful for investing in the future, not just in recovery. So but it's certainly worth, I mean, you've got the rest of this month to consider whether you need a bounce back loan in the first place, for example, and to explore this. You can have both, but obviously that will come down to the mechanics of what your business can justify it needs. They still have to go through a normal credit procedure. Other than the bounce back loan is a self-referred loan that you can obtain, but CBILS and these recovery loans, I'm sure, will go through normal credit procedures despite the government backing 80% of it. So again, reach out to your team, get your plans together for the year ahead. I know some of you would have put the business on hold really if you've not been able to operate, and you've hopefully had a rest and you're ready to go again. But it's a good time now to think about the future, what you want to achieve with your business, and what your business needs in order to deliver on that, because now's the time, with grants, with the loan opportunities as well, to have a proper look at this and take advantage of it, because there's no guarantees how long it stays.
Ken, practically, how have you seen the CBILS, and how have you found them? How easy is it for people to actually achieve them?
Yeah, I mean, it really depends on the circumstances, Matt. I mean, obviously the bounce back loans were almost an automatic one, and to be honest, they were 100% backed by the government. The CBILS with 80% backing, obviously there's a lending decision for the banks there. This new loan scheme, the recovery loans, is actually quite similar to the CBILS in terms of 80% guarantee, but they've also brought in the other provision from the CBILS that on loans up to 250,000, the bank can't take personal guarantees, and no charges on private residences, which is an important thing to give people confidence. But they will be, I suspect, administered by the banks relatively similar to the CBILS type of situation. They've come up with a few pointers about it. Loans between 25,000 and 10 million, the figures, available to all businesses. There's actually a small press release they issued last night, which we can probably put a note on that in the chat or at a later stage. If any people would like to see that, we can point them towards that.
Fiona, a factual one here. Super deductions, when do they come into effect? And will that be dependent on on a company's year end?
Yes, they come into effect from the 1st of April 2021, and then they run to the 31st of March 2023, which is the point at which the corporation tax rate increases to 25% for some companies. But that's 130% is apportioned if your accounting period straddles the 31st of March 2023. So if that's not your accounting period, then there could be some planning points of moving that around, and that's something to think about in conjunction with that, and also the increase of the CT rate from that date.
So for someone with a 31st March year end, it's quite simple, fits in line with their accounting year. But for someone outside 31st March, they really need to have a think about the planning on that.
Yeah, I was just going to add, there's a couple of very strange points on that, because as Fiona says, the 31st of March 23, when it finishes, the rules seem to be slightly odd about apportionment of the allowance over a period. So it may be that you want to change your year end for that. There's also a point that if you sell any assets which you've actually claimed the 130% deduction in, you actually have to add 30% to the deemed proceeds for when you work out tax on it.
Yeah.
Which is a slightly odd one.
Yeah, super. Ken, there was the job retention bonus that was announced at one point last year. Then that seemed to be mothballs with the winter economic plan, but the thought that it may come back at some point. Was it? I don't remember it being mentioned yesterday. Have I missed something there?
Nope, no, Matt, you haven't. It's not been mentioned at all. The Chancellor did get a little bit of criticism from HMRC when he announced it on the sort of review. There was a question as to whether it was the right use of funds, and there's been a stunned silence ever since. So we shall. It's watch this space to see whether it comes back or not. But at the moment, it seems to be off the table.
It's worth noting, Ken, though, that I think originally when it was first announced, we were coming out of lockdown, weren't we, at the back end of 2020? And I think because furlough was reinstated, it was sort of deemed that you could just furlough people in order to get there, which is why I think they put it into the long grass, if I'm correct.
Yeah, I mean, it was originally going to be for, I think, when furlough was going to end at the end of January 2021. And it was basically if you employed someone who'd been on furlough at 31st of January 2021. But now, I mean, the way that the furlough scheme is, I mean, the extension of it to the end of September, which is beyond the expected date of 21st of June for the sort of reopening of the economy. And there's a little bit of a tailing off on the furlough scheme, whereby, as we know, from July, August and September, the amount the employer contributes is increasing steadily. So it may be that they've decided, as you rightly say, Matt, Martin, that to kick it into long grass for the moment. But like all these things, it may come back. But we'll watch this space.
Provided with the most adaptable, I'm glad I started with that. Fiona, nice one coming from you. Would building a company website with integrated marketing and back office workflow be considered as a valid capital investment for a super deduction?
Yes, I believe so, as long as it was a new investment and it would need to be capable of doing something like sales rather than just being the visual representation of your business. Otherwise, that might be more of a revenue expenditure. But I believe that would be covered by the super deduction. Ken, do you have any thoughts on that?
Yeah, I mean, I think it's a possibility. It just goes back to the old point of now we're arguing for capital rather than revenue, perversely. And bearing in mind, we do have some assistance where over the many, many years, HMRC have argued for capital rather than revenue. We can just turn that around. But yeah, I think there's an argument, but we can have a look at it in detail.
Yeah, depending on what the website does and on a case-by-case basis.
Okay, yeah, so if you broadly, if you have a website up and running, altering it, that's likely to be revenue. Yep. If you're actually designing something brand new that is selling with the bits in the background, then yes, that does sound like, I mean, it sounds like a capital investment.
Yeah.
Okay, cool.
And as Fiona said, there's some nuances to it as well. It's you certainly need to, if you can, be showing that it helps you sell, either direct to customers or actively brings customers to you. So it can't just be seen as sort of an information piece, if that makes sense. So there are some rules within the allowances and the accounting criteria for that to be recognised as the asset in the first place.
Yeah, I mean, there's also the specific intangible assets regime as well, as that applies to, possible website type expenditure. So again, we can look at that.
Super. Just for information, there are a couple of people with hands up. If you could just quickly pop your questions in the Q&A tab, then I shall pick them up from there. If that's okay, please. Fiona, another one from you. Something that was it came up in the budget yesterday, but people don't tend to know a lot about. What is a free port, please, and how is that going to work?
A free port is a designated area which is free from tariffs and duties for anything that's coming into that designated area. As long as those goods don't leave into the wider UK, then those duties aren't added. There are also various other tax reliefs of operating in those areas, such as reduced employers, national insurance, business rates. And the idea is to encourage investment, encourage the manufacturing within those, and then generate jobs, which will mean spending in the wider economy. There are going to be 8, the largest being in Teesside.
Okay, thank you very much. On the, we've said we've got a tax rate still going to be at 19% up to 50,000. 250,000 above it's going to be at 25%. What's the rate in the middle going to be, please? Because the talk of some mixed rate.
Yeah, marginal rate relief, which we did used to have back pre-2015. So we are used to it. It will come back in. The effective rate of that band is 26.5%. And you may say, well, that's higher than the large 25% rate, but it's to account for the average between the 19% and that bracket between.
Super, thank you. We've also, yesterday there were announcements about there's going to be more investment into R&D to try and stoke the economy. How does this work? Is it going to be very different to the old R&D? And how are the rules around that going to work, please?
Well, I think there's a couple of things. There's a general consultation on R&D anyway going out, but there's a little bit of a further restriction on R&D coming in to the. I think the R&D restriction was 20,000 plus 3 times the POA bill, but as for claim immediate tax credits, plus, but in terms of certain specific areas, specific types of R&D, that limit was reached. But there is a more general consultation which was issued yesterday on R&D.
Yeah, a bit of a mixed message. They're thankfully the government are clearly sort of suggesting they're supportive of R&D and helping make sure the UK stays a hub for technology and advancement. But they clearly feel there's some abuse in the area as well, hence putting the cap in that Ken's just described. So that cap starts from year ends that begin 1st of April onwards. So we've got many tech businesses that don't employ it at the start because they don't want the risk of taking on employees. They're trying to build a product and test product, and they tend to subcontract out. So those are the ones that would be most at risk of this new risk. If they're not employing anyone, their cap is going to be brought back a lot because they've got no PAYE bill for the extra enhancement. So it's worth looking out for that. There's some immediate things like reviewing year ends because you know, if you can make your year end not be the first start at the make the start of period not be the 1st of April, you might be able to go a bit further before you have to decide whether to becoming employees, that type of thing. But it's something worth looking at if you're reliant on an R&D or that's within your budgets. It's worth just double checking whether the cap's going to apply, and indeed whether it's worth reviewing your year end to make sure that you can maximise whilst you decide whether to change or not.
Super, thank you. I've had a follow-on to that. Is someone's wanted to know if they create a business website, can that qualify for R&D? I guess everything's in it. It depends. But Fiona, have you got a couple of guidelines on what is likely to qualify for R&D, please?
We normally see employment related costs such as salaries, pensions, any cost of employing those people that are working on R&D. That could be apportioned if somebody's not working full time, or it could be 100% of those costs. Also consumables, any payments to subcontractors to do work that R&D for you, although they are restricted to 65% before applying the enhanced deduction.
Super, thank you. Martin, bounce back loans. There's some changes to the way they're going to be paid back, and someone has suggested that they understood that they're going to be changing to something more like a student loan type repayment based on the growth and the profits. What's happening with that, please?
So my understanding is that they're realizing that perhaps the pandemic's gone a little longer, particularly for people that took a bounce back loan out right at the very start, and that businesses haven't necessarily had the time to get themselves ready and or fully operational again in order to start building up the cash to start repaying the loans. I mean, the rate was very good. You know, the payment terms initially were very good, but they've certainly extended those payment terms, and they've now, my understanding is, put in if there's it's almost a time to pay arrangement. If you can see that you're going to struggle with the payments, you can start having discussions about moving that through into something more manageable. I'm not sure that they've, unless you know anything else, the rest of the panel, in terms of whether there's a sort of student loaner type arrangement in place for as your profits allow you to pay off the loan itself.
I haven't seen that. I've seen the extension up to 10 years from the original 6 years.
Yeah, I'll certainly have a look at that. I saw the question come in, so.
Yeah, I think I've seen it as commentary in the press rather than a government announcement is where I've seen it, but super. Ken, COVID does look like it's going to be extending. Is there more support that's going to be available to people?
Well, I mean, there's a couple of things, Matt, on that. I mean, obviously we've seen the furlough, which has had, obviously, there's also the self-employed income support scheme, where we've got the 4th grant of it, which is going to be 80% of the 3 months average trading profits. Interestingly on that is there's been a bit of a move to take into account the most recently submitted tax return, i.e. the income for the year ended 5th of April 20, which would have been submitted by January 21. And that does bring then people into the self-employed grants who started business after 1st of April 2019, which was quite a criticism of the original scheme, that they were sort of forgotten. So people have been brought in by the new grant. There are different conditions which have come into this grant, and one of both for the 4th grant and also an indication for the 5th grant, where there's actually a turnover test. I can run through these, but any of the other panel members like to pick up on that, on the various tests? Yeah.
So just to mention on the 4th grant itself, I think it's late April that we're likely to be able to apply for those as the self-employed. And I know there was a lot of pushback in the press overnight because that leaves quite a funding gap for many who've had the 3rd one at the start of the year, end of the last year, and have now got to wait and effectively the 4 months before they can get access to cover the period that is ultimately February to April. So there's a lot of press on that. So they may move on that. But the reason my understanding is that it's put to that late level is because these, the 1920 new self-employed can now become part of this. So they needed to give themselves enough time so they can assess everyone properly, not just the people that were already continuing on it. Particularly on the 5th grant, if my understanding is correct, it comes down to a turnover test where you can, I think there's a 30% rate involved as well.
Yeah, 30% fall in profits. Oh, fall in turnover.
Turnover, yes, yeah.
You get one rate if your turnover has fallen more than 30%. Another rate if your turnover has fallen less than 30%.
And I assume that's not something that they're going to know immediately from that. Because is that based on what you've done in the previous year, or is that going to be based on where you are right now?
My understanding is it's where you are right now, but again, they've said that they'll give further details of it.
Yes.
What's a little bit odd, which is something we spoke this morning about, which was that the document they issued late last night referred to the grant being given as 80% of 3 months' profits, but it's for a 4 month period.
Yes.
So we think that that 5th grant, should we say, it needs a little bit more work on it. It's what we would call in accountancy terms a work in progress. But the 4th grant is around anyway, and that's a positive. And I think including the people who started business after first after 1st of April 2019 is a positive move.
Okay, on the fifth grant, if it does come down to future profits, HMRC won't necessarily know that from your reporting. So on that basis, I imagine it will be down to a sort of a self-reference on that as to how you've done in order to obtain the grant. So, but they did put some legislation in, Fiona, didn't they? To if there's any grants taken in error, they can do 100% tax in order to claw it back. Is that correct?
Yeah, that's right. To allow them to take it all back if they have been issued in error, or if your circumstances changed in the future. That's why it's very important to keep records of where your profits would have been, where they have been as a result of COVID, and everything that means that you've had to close, or you've had to lay off any staff or put them on furlough, just so you can prove that that reduction in your turnover.
Yep, absolutely.
Super, thank you. Someone's asked about the grants for employing apprentices. So apprenticeship scheme has been in place a long time, but I think it was extended a little yesterday. Fiona, did you see this?
No, this isn't something that I saw in great detail. Ken, did you?
Yes, Ken?
Again, it's another one probably I haven't reviewed detail as well, but I mean, yes, they are just pushing the apprenticeship scheme, and that's something.
Because of course we have had some apprentices in the office, so it's something we have used. It's been a very good scheme for taking new people on. But if someone wants to come back to us, then we'll give you more detail, I guess, on that separately.
Yeah, I mean, just to couple with that, I don't think they apart from extending the scheme, they didn't give too much more detail on this. So this is what's already in place. So they're encouraging you to take on new staff and making sure you get an amount for hiring them. I think there was discussion as whether that amount might get increased as well. I think it was originally 1,000, and that may be go up to potentially 3,000. So that's obviously good news for anyone looking to take people on. And then again, it came up, there's the training schemes involved as well. Now they've got a digital and a management scheme that you can apply for now through the websites to register your company's interest. So they're clearly trying to help you upskill your staff, encourage you to take people on and train them. And so there are opportunities out there for government-backed training, largely, I think, through the business schools at universities is where that's going to get delivered.
Yeah, and particularly for the younger, the 16 to 24-year-olds.
Super, thank you.
Yeah.
There was quite a bit of talk again in the commentary about the tax allowances remaining the same. I think they're allowing the tax allowances to change this year. I understand that's because HMRC have already got their software in place, so they don't want to play with that. But so the tax allowances are going to be frozen after that, and that leads to the famous fiscal drag. So that's the question has come in. You've got the Conservative Party saying they're not going to raise taxes, but this will have an impact on people's lives. Any thoughts from the panel, Ken?
I mean, it's still on, Matt, because, we don't really want to get into politics particularly about it. I mean, what the government has done is it's tried to avoid having vast amounts of tax rises. Clearly, it's got a couple of things it needs to do. One, it needs to try and stabilize the position to stop actually spending, running at a loss, so to speak, because in the last year or so, its outgoings have been horrendous with all the support. But secondly, after that, it needs to try and, having stabilized things, to try and get some of the money back. And rather than going for large tax increases, apart from corporation tax, which is what we've seen, what we're seeing is generally everything staying the same. And yes, there will be a little bit of extra tax people are paying because as their income rises, their personal allowances and don't rise, and tax bands don't rise. But that's the way they've determined to do it. It does always give the government the opportunity as well to change the plan if they find at some later stage, and perhaps being slightly cynical, slightly before the next general election. But if they find at a later stage that things are a bit better, then they might relax these rules. But no, I mean, generally it's been a budget of stability. The only big tax rise we've seen is the corporation tax one.
Yeah, sure.
Yeah, personally, I welcome the certainty. I know you're absolutely right. By freezing those rates, not increasing the personal tax band, naturally things will inflate over time. The price of our goods will increase as we go forward, and we won't be getting any benefit of that. But we knew that there's huge expense as they laid out yesterday that the government have put forward in the furlough scheme, in the bounce back loan scheme, and we're still, the furlough scheme has been extended to September, so it still gives some insight as to how long this is likely to go on for, even through a phased approach. So there's a lot of money that's gone out, and as Ken, I think you mentioned earlier, that the biggest tax take tends to come from income tax and national insurance. So they're the obvious places where they can go and get it. But there's an understanding and appreciation for where we're at. So certainly from my perspective, when advising other businesses, we've got some certainty over the next 2 years. And I don't think that's a bad thing to be in, even though those rates may not be, rising with inflation, other things. At least we know where they're at as we stand, and you can plan for that.
Yeah, in terms of planning, things like pension contributions would extend that basic rate band. The lifetime allowance has been frozen, but the annual allowance of 40,000 per annum or tapered down remains the same.
Super, thank you. Just as a warning shot, that we will be closing up in not too long. We've got time for a couple more questions. But so if you do want to have a question, please make sure you fire it in and we'll try and get through them as quickly as we can. As a broad brush position now, after the budget, or as someone has said, the non-budget, what should people be doing to change their tax behaviours? Is there anything they should be doing to change their plans at the moment? How would you be looking to advise people when they're doing their tax planning? Ken, do you want to start us off?
Yeah. I mean, I think the first thing is to follow what Martin said. It's good to have at least some certainty going forward. I think the planning is going to be around a lot of planning around capital expenditure, because the allowances are generous, and then looking at the position about profitability, expenditure, whether we spend capital expenditure now, whether we defer it, what our charges are likely to be. Our tax charges likely to be, particularly if we're in a company environment, planning to see where we are in advance of the hike in tax there. Losses, companies which have had suffered losses, there's the free carryback businesses, we can look at that. The capital gains tax point is one which, as Martin said, is kept under review. So I'm sure, as it'll be under review all the time, there will be businesses who are looking to sell, might say, well, we want to sell in advance of the next budget in case it changes. But basically, what the government has tried to do is to achieve a relatively stable tax position where people know where they are, in order they can actually carry on running a business, building it up, and for the government's terms, paying some POE, national insurance and VAT over, which is what they want to do.
Martin, practically, when it comes to planning for a company, obviously you do forecasts. How does that tend to fit in with the tax planning?
Well, I think it's got even more important, I have to say, through where we're at right now. Not every business has been able to carry on trading. And as I mentioned earlier, there are grants out there are loans out there that are available, and probably more readily available than they ever have been. So I think the planning for me comes down to two things. One is there's obviously tax planning that comes with the forecasting. You can have a look at, what you're likely to spend, on capital expenditure, where you think, you're likely to finish some of the years up. And as Ken said, if you've got large losses right now, there's the potential to carry that back to further periods to get to reclaim some tax you've paid in your more profitable years before COVID hit. So there's lots of planning from a cash flow perspective. So it can be quite important on that side of things. And getting into that knowledge can help you decide whether it's worth a year-end change, for example, whether it's worth timing certain expenditure to fit with the tax rates. But we always say you should try not to let the tax dictate your business decisions where you possibly can, but it still needs to be a consideration because there's significant amounts of tax around, there's significant amounts of planning opportunities around. But the other thing as well with the forecasting is just to get that insight. A lot of people would do a forecast which is profit and loss only. The important thing, in my opinion, is to monitor that balance sheet and cash flow with it, because sometimes it takes a while for your cash to turn around and things like that. So it's important to understand that and see if you've got any gaps, because in my opinion, now's the time to be looking at the recovery loan, for example, if you need one. And I wouldn't encourage everyone to go get a loan, because if you can manage it without, then obviously it's better not to take the debt on. But the lack of PGs, particularly for some of the smaller businesses, that's normally what puts people off potentially getting a loan looking to expand, is knowing that their house is on the line. Those provisions are covered for at the moment, and come September, who knows what happens if we open up again as normal. I'm imagining some of these reliefs go away and they don't get viewed in the same way. So I'd say forecasting and planning is right, to know where you think your business is going, so you can plan for the tax, obviously, plan for anything clever we can do and support you with, but also to know what your business needs so you can guarantee your safety, your future.
Super, thank you. Fiona, we've obviously got 1 month and a day till the end of the tax year. Is there anything people should be doing over the next month, just tax planning wise? Is there anything you'd be recommending that they look at?
Various things, making sure that you've used your pension if that's something that you invest in. For a lot of our clients, we are projecting the tax liability for 2021 to enable them to make investments into enterprise investment schemes and carry those back or to the previous year or to the current year to maximise those tax reliefs. Otherwise, we might be looking at charitable donations. In terms of the losses that we've talked about that can be taken back 2 years, it's important to note that that's not just limited companies, that's also unincorporated businesses as well. So looking at your position, your losses in this year and your profitability, also maybe changing accounting periods for those unincorporated businesses. That's all part of the planning, and that not necessarily pre-tax year end, but all part of what we should be looking at.
Super, thank you. Ken, UK Tax Day is 23rd of March, looking at a 10-year tax strategy. Any comments, please?
Well, thanks, man. I think actually there's probably a more significant day coming up, which is the next day, the 24th of March, which is when the next quarter's rents are due. And that's a major issue. And I'll just very, very briefly, as some of you are aware, that the government changed the provisions so that, in effect, commercial tenants couldn't be evicted for non-payment of rent from March 2000 onwards. So far, March 2020 onwards. So far, there's many commercial tenants haven't paid their rent for a year. Commercial landlords haven't paid the rent for a year, haven't received any rent for a year either. I was speaking to an insolvency practitioner a couple of days ago, and they are being approached by a number of commercial landlords. And there's a view that the moratorium on being able to collect commercial rents is going to be extended for possibly another 2 quarters. So it would mean that commercial tenants wouldn't need to pay the rent on 24th of March or on 25th of March or 24th of June. So we could end up with a situation with a lot of these tenants owning vast amounts of rent. And there's got to be some move from the government as to how they're going to deal with that, how that's going to unwind, or we're going to find major issues there. We're also going to find, not just with businesses going bust, we're going to find major problems for landlords. So I think that's probably 25th of March, that day. That's probably a slightly more significant day where there were suggestions something might have been said in the budget. It wasn't, right. So we're waiting announcements on that.
Right, super. Thanks, Ken. Fiona, Martin, thank you as well. I think that brings us to the end of our allotted time this morning. Thank you all very much for attending. If you have any follow-up questions, please do get in touch with your Burgess Hodgson contact. Alternatively, feel free to give us a call or to email on info@burgesshodgson.co.uk. I'd also exhort you to keep an eye on our website for updates and clarifications as they come about. I understand that in the last hour, a link to our written budget summary has been added to our website homepage. So please do feel free to have a look and download that. Thank you all again for attending, and have a great rest of the day.